starting with FAAS, which is Digiasia. This one's pretty obscure, and the first thing that jumps out is the extremely low trading volume. That's a red flag for liquidity. If you ever want to get out, you might have trouble finding buyers, and the bid-ask spreads could eat you alive. Technically, the stock is in a pronounced downtrend. The momentum is negative, and short-term forecasts are brutal, with some analysts projecting as much as a 49% drop over the next 3 months. That's not just a correction, that's a nosedive. Now, you might see some long-term forecasts floating around that are wildly bullish, predicting eye-popping returns by 2030 or 2035. But honestly, those are more like hopeful speculation than anything grounded in current fundamentals. There's no real evidence from the company's financials or business model that supports those kinds of gains. If you're thinking about FAAS, just know that you'd be betting on a total turnaround. Like and subscribe. Next up is PTIX, Protagenic Therapeutics. This one's a biotech play, which means volatility is baked into the cake. Short term, there are some bullish signals. Some technical analysis suggests a possible 16% pop in the next month. That might sound tempting, but when you dig deeper, the broader sentiment is pretty fearful. The fear and greed index is tilted toward fear, which means a lot of investors are skittish, and the volatility is sky high. That means you're just as likely to see a sharp drop as a quick gain. Looking further out, the forecasts are all over the place. Some analysts expect a catastrophic drop like nearly 80% by the end of the year, while others are dreaming of big gains by the end of the decade. That kind of disagreement usually means the company's prospects are highly uncertain, maybe hanging on the outcome of a clinical trial or some regulatory decision. Now let's talk about HCTI, Healthcare Triangle Inc. This one's also in the healthcare sector, but the story here is a bit more straightforward. The sentiment is bearish, and the stock is currently trading above what most analysts think it's worth, which is never a good sign. Short-term projections are for a slight decline, and there's just not much positive momentum. There aren't any compelling catalysts on the horizon, and the fundamentals don't suggest a turnaround is imminent. It's not oversold enough to be a value play, and it's not showing any signs of a breakout. Finally, we've got Mullen Automotive. This stock has been on a wild ride, with big swings up and down, but the overall trend is still negative. Yes, there was a recent spike on high volume, which sometimes signals the start of a reversal, but in this case, the broader technical picture is still bearish. The company is in a wide, falling trend channel, and there's a lot of uncertainty about its future. The F sector as a whole is super competitive, and Mullen hasn't really distinguished itself with strong sales or a clear path to profitability.